Hi, everybody. Welcome back to TSAM Digital. I'm Anam Khan, and today with me I have Jason Mitchell. Jason is the co-head of responsible investment at Mango. Hey, Jason, how are you?
Very good. Thanks for having me on here. I'm really excited.
It's a pleasure. Thank you for taking out time.
Great.
Jason, to kick things off, it will be brilliant if you can give us a brief introduction and let our audience know a little bit about yourself.
Sure. As you mentioned, I'm co-head of responsible investment at Man Group. Man Group is a global multi-strat asset manager, particularly with some exposure on the alternative side. But what that means is we have five distinct businesses, two very different quant businesses, a discretionary business, a private markets business, and a fund of funds business, which sounds like a lot, but I think it's actually made sort of examining responsible investment and ESG incredibly interesting because it sort of means that we have to sort of solve for a lot of different types of strategies and asset classes.
Brilliant, brilliant. So COVID-19 pandemic has changed a lot of things. How do you think the COVID-19 pandemic has changed the way asset managers look at ESG?
Yeah, it's been fascinating, to be honest, over the past year because there's been so much coming into this year that I think there were expectations of potential delays. And what I'm talking about specifically is sort of regulation coming out of the EU or some other areas. And effectively, that regulation has kept going. There have been small delays, but if anything, I think COVID has sort of accelerated this push. Probably more so in the environmental or specifically the climate area. I think I think one of the things that has sort of forced investors or sort of the markets to sort of think about is that if you were to look 10 20 30 years ago, if anyone were to sort of imagine the relationship or the linkage between a global health crisis and so the stability of global markets and global economies, I think people would sort of struggle to make that kind of connection. And I think what the COVID has done in an incredibly profound ways is at least point to the uh, that instability or sort of the lack of resilience or the lack of stability, and sort of made us pause and sort of think about not just that in the COVID sense, but also in terms of other systemic risks like climate change. Um, I think, in specifically on that point, I think what's sort of been interesting about it is when you look at COVID and sort of the nature of the COVID issue, it's sort of it's unexpected in terms of scope and speed and size. It's sort of a non-linear issue, which effectively is what climate change is. And so it's sort of helped, I think, imagine or create sort of a larger sort of buy-in for other types of systemic risks. And like I said, it has, I think, sort of pointed to climate risk specifically. I think laterally, though, it's really kind of forced us to sort of think about the second and third order effects about what the pandemic, might have. For instance, in terms of labor rights, what are the implications that the gig economy, or sort of the unemployment rate, and the responses by governments. How is that? How should we think about that? Even more so, what about the types of businesses that we're depending upon, the nature of them, and what implications does that have in the human rights realm? For instance, in terms of the rights for privacy. So it's actually been quite interesting. What I'd expect specifically out of that is, potentially some of these social issues to emerge or sort of manifest as stewardship issues, areas that we would focus on, particularly going over the next 1 or 2 years in terms of shareholder rights, potentially with certain companies.
Thank you very much, Jason, for that. In the recent times, we've been hearing a lot about Net Zero Asset Managers Initiative. It would be great if you could shed some light on that and also how it will contribute to low carbon economy.
Yeah, it's a great question. I've actually been personally sort of blown away about the sort of momentum behind, so they call it the race to net zero, which is only a couple of years old. Predating that is sort of the move to go carbon neutral. Effectively, what the race to net zero is doing is sort of at a country or even continental level, and that's now going into the corporate sector and into the investment sector. But you're basically trying to take a company or as an investor or a portfolio of investments. You're trying to sort of align that to the Paris Accord, and then by 2040 or 2050, 2050 is sort of the formal target by the Net Zero Asset Owners Alliance and the Net Zero Asset Managers Alliance. But you're basically trying to take a portfolio to net zero by that time. I think what's interesting is, I mean, there's still areas to think about in this race. We've seen a number of commitments from companies and investors already. From a man perspective, we have not yet committed to it. We are absolutely spending a lot of time thinking about it. But that said, there's some areas that we need to think about a bit and sort of address. Clearly, offsets have been a very controversial area, according to the Institutional Investors Group on Climate Change. Investors can't use offsets to reach that by 2050. So what are the other mechanisms? There is carbon removal technologies that people are depending on. But again, these are back-end loaded assumptions, I think, that are quite tenuous. So right now we're going through a scoping exercise, looking at a lot of different data sets, trying to understand the shape of the curve to get there over the next 10, 20, or 30 years. So, which would put us sort of in the position to really kind of speak about it beyond just simply committing to this.
Mm-hmm, mm-hmm. And talking about data, how can quant innovate and optimize ESG data or climate data?
It's a great question too, and this obviously has a bit to do with sort of the net zero climate risk. I think what's fascinating about ESG right now is that, you know, historically data has always been the complaining point, the point of complaint by many people. And the reality is we just have to accept it. There are a lot of problems around data, many that we've talked about endlessly, which is, you know, generally the lack of history and the lack of comparability. That said, I think we are seeing a better data now. We're seeing better standards, or the emergence of standards. We're seeing regulatory as well as statutory reinforcement around that reporting, which is to say that, again, we don't have 10, 20, or 30 years of data similar to other financial metrics with which to make a very strong claim about this. But I think what quant does, or what quant can add in this area, is, you know, effectively the capability to apply new tools within that toolkit, rather than just the fundamental bottom-up analysis. By tools, I mean natural language, you know, processing, or even artificial intelligence, or machine learning. But I think also you can find even, you know, sort of basic economically intuitive quant research approaches, you know, that can look at these data sets. Let me give you one example. You know, when you don't have a lot of history around ESG data, and, you know, we think you have maybe about 10 or 12 years of good data. By good, I mean unrevised data, as was data. But one way in which you can sort of make that stronger, a richer data set, is effectively work with other data sets and sort of build a single, stronger data set. You know, and again, I think that limits your, just from an intellectual perspective, that limits your ability to make a strong claim around performance. So we're always mindful of that. But what you can produce is something that is quite new and sort of telling about risk, where it exists, where it lives, how it sort of acts across sectors, regions, different asset classes, you know, effectively towards the end game of as a manager, or to your end investor, to an allocator, how can we sort of help them understand this kind of risk and help them allocate to or away from it in the context of their entire risk budget?
Mm-hmm, mm-hmm. That's great insights, Jason. Moving a bit away from data and going into the regulatory landscape, how does regulatory change impact sustainable investments?
Yeah, I mean, we're going through this unique period right now that is absolutely profound. And I'm speaking specifically of the European Union's legislative efforts. So we saw a number of years ago then the EU come out with the EU taxonomy, effectively a way to classify economically sustainable activities. And again, that's still being refined. But aside from that, we saw legislative efforts around green bonds, indices, but the latest one, which effectively goes into force on March 10 of this year, so less than a week from now, is the SFDR, the Sustainable Finance Disclosure Regulation. And again, I mean, this is one of the most ambitious pieces of legislation, and I don't say that, as sort of complaining about it, but I think this is sort of great for the industry. But this is effectively doing a couple things. First, it is providing much needed protections against greenwashing in products. I think we can all agree that we want to sort of make products that call themselves ESG, or where ESG is a key feature. We want to make sure that there's integrity and credibility to that, and understand what that means. So that's one thing. The second thing is, in the most explicit way, they are steering capital towards sustainable investments and away from unsustainable investments. And I think what's sort of interesting about that is that those two objectives would seem to be very much aligned. I think what the investment industry is actually starting to realize is that there's some inherent tension between them. I think from a EU policymaker's perspective, they see this as a way to fund the just transition or the low carbon economy towards their own 2050 net zero target. And from that perspective, initially, and I mean 10 months ago, there was this idea that even the marginal unit of capital being directed towards sustainable and away from unsustainable would seem to sort of fulfill that. I think what you've seen from the industry is a step back to say, but what actually does that incremental or that marginal unit of capital look like? Does it meet a certain sort of threshold? How does it look relative to our suspicions around greenwashing? And so I think out of this, what you're going to find is fewer but much higher quality funds that call themselves Article 8, which are sustainable, they're light green funds, and fewer funds which are Article 9, deep green funds, but it is energized and animated the industry in a way that I've never seen before. And I think what's also interesting is, what are the add-on effects in the US from the Biden administration? Even over the last couple of weeks, we've seen some changes within the SEC, and now the SEC start to make sort of signal a clear move towards greater disclosure, which doesn't feel like it has the teeth that the EU has. I think the Biden administration is sort of hampered in terms of the legislative efforts that they can do, but nonetheless, they can certainly regulate and enforce a greater degree of ESG disclosure.
Sure, brilliant. And I would like to ask about MAN's strategy of how to deal with and target climate change. Could you let us know some insights around there?
Yeah, I think we're doing it from a number of different ways. So, I mean, I'd take a step back. So, as a FTSE 250 listed company, as a PLC, first we have our own targets around going carbon neutral, and that's by 2030. And we have a very detailed sort of timeline about how we get there. So I'm quite satisfied with that. I think secondly, in terms of how we address climate change, there are a number of different areas. First, what's measurable is manageable. So a big effort that we've had over the last couple of years is to build out an analytics platform to understand not just ESG risk, but specifically climate risk. Where does it, again, live or exist, and how can we price it, particularly using existing carbon markets, and make certain extrapolations, and effectively go into strategies or portfolios and do a number of simulations, including stress testing or looking at sort of distressed assets, just given, let's say, shocks in carbon markets. So first, we just want to basically understand the sensitivity of portfolios relative to that. We also want to look at sort of alignment to the Paris Agreement, So that's in our analytics platform. In terms of product development, I mean, clearly we're doing that, albeit just given the breadth of man's strategies in a number of different ways. One of the easiest ways, just from a quant perspective, is effectively for clients or for general strategies to impose constraints, sort of an upper and a lower constraint or bound around the amount of emissions relative to, let's say, an index or some benchmark that you want to do. Certainly, we're looking at strategies that focus on the the energy transition, which is to say that it's looking at sort of who is disintermediated, the winners and the losers in terms of that. I would also say, and this is relatively new for us, and it's new because it's sort of historically, say the alternative and the quant has been sort of the largest area of exposure within Man Group. But stewardship is it's been a big focus for us, particularly over the last 3 years. But particularly, I'd say over the last year, where we have done a number of restructuring, and we're starting to see the fruits of that, not just through sort of the mechanical support of climate shareholder resolutions, but for the first time in man's history of 238 years of actually now co-filing in a climate shareholder resolution, which was with HSBC.
Mhm. Brilliant. This all sounds very interesting. We're coming towards our last question. What is the advice you would like to give to firms who have recently started their ESG journey?
Yeah, I'd say two things. The first bit of advice probably is less relevant for European funds, but who are sort of under pressure from the EU sort of regulatory regime. But I'd say that the burden from a reporting perspective, from an analytics, a data cost perspective, from a resource perspective, might seem overwhelming and intimidating at first. But to be clear, this is not going away. I remember we went through a cycle of this about 10 years ago where we saw sustainability and particularly renewable/thematic funds emerge. And following the European debt crisis in 2011, 2012, a lot of that was treated in a sort of a discretionary way, and we saw outflows, as an industry. I think now there is such backing from a regulatory perspective that this isn't going away. There's so much normative change that I would say, be prepared to heavily invest in this, and frankly treat it as a competitive advantage. These are deep moats, particularly on the data side. Secondly, I'd say that having been in the finance industry for almost 20 years, there's no greater area that is sort of as collaborative as the ESG sort of sustainable finance area. I'm always surprised at the conferences or organizations. I call them organizations. I would almost call them epistemic communities, where there's a lot of knowledge sharing. That's the United Nations Principles for Responsible Investment, the Investment Association, the AMA, SBAI. But it's incredible how much knowledge sharing there is between managers or asset owners, in this sort of effort to understand what these risks really represent.
Brilliant. Thank you very much, Jason, for this insightful discussion. Really appreciate it. Hopefully our audience have enjoyed it as well.